Hi everyone, thanks for listening our presentation. My name is Xulan Zhang and I'm joined by my team members An Qiyang, Chen Haoni, Ge Yu, Si Yizhao, and Chunyu Wang. Together we present Group 16 for this Applied Corporate Finance project. Our presentation today will focus on the strategic merger and acquisition proposal evaluating the financial and operational feasibility of Block Inc. acquiring DocuSign Inc. Now, at first we can see the Block Inc. was founded in 2009 as Square, revolutionized small business payment processing with its integrated platform, and listed on the New York Stock Exchange under the ticker symbol SQ in 2015. It has driving the innovation in digital transactions. And now looking for the target company, DocuSign Inc. It was founded in 2003 and headquartered in San Francisco, is a leader in electronic signature and digital transaction management. Since its 2018 Nasdaq IPO, it has continued to expand its global reach.
Let me introduce companies. Block mainly focuses on mobile payments and fintech services. DocuSign's technical strengths in electronic signatures and protocol management. Block can deeply integrate its payment and commerce solutions with DocuSign's protocol management tools to create a full chain of digital transaction services from payments to electronic signing. For the similar M&A deals, American company Square plans to acquire Australian financial technology company Afterpay in an all-stock deal to take advantage of the buy now pay later practice. After the acquisition, each Afterpay shareholder will receive 0.375 Square Class A shares and also have the option to pay up to 1% of the transaction in cash. With this acquisition, Square and Afterpay are leveraging each other's competitive advantages to attract new consumers and new markets. Afterpay is also expected to boost the combined company's growth.
The following part is about the M&A model. Based on historical acquisition data and the situation of peer companies in the industry, we make the following assumptions. At the same time, we also have established 5 different scenarios to simulate different situations in the real world. These scenarios, numbered from 1 to 5, represent a range of conditions from favorable to unfavorable. We anticipate that there will be both revenue and cost synergies. In first merger period, Block will be able to market its products to new customers. By consolidating existing resources, the two companies will enhance the efficiency of capital utilization. Based on this analysis, we expect the synergies on the different scenarios outlined in the chart. Then, we use the discounted cash flow model to calculate the equity value. In a good scenario, the target shares valuation is $5.8. The acquired shares valuation is $12.28. However, in a worst scenario, equity value per share of the two companies are 0.58 and 1.03 respectively. The outcome of the accretion and dilution analysis is as follows. From the chart above, when the stock price is equal to $78 and the acquisition premium is less than 30%, the M&A will increase the post-transaction earnings per share. The same goes for the situation when the stock price is $79 and the acquisition premium is less than 25%.
Here to see like under the capital structure table, the first category is equity growth. It highlights a significant increase in equity post-transactions. This demonstrates enhanced financial stability and increased shareholders' value. The following part is the cash. It also shows the huge increase in these categories. They improve the liquidity and strengthen the company's ability to invest in growth and management debt. And because during our first assumption, we assume there's no debt happened, so this reflects the optimized capital structure situation and also the important part of reduce the financial risk. This will increase the overall company values. The enterprise value will grow, and when the enterprise value grows, it will directly benefit into the shareholders. There's 4 important costs of funding of transaction. The first is the equity issuance fee, which arises when the new shares are issued to finance the deal. And another one is the debt issuance fees, including the costs associated with raising debt capital, such as underwriting and legal expenses. And also the other closing costs, which cover various expenses like advisory fee, due diligence, and regulatory compliance. The last one is restructuring charge. These are the costs happen to readjust operation or to integrate the acquired business effectively. And the last part is premium influence. During our M&A case study, we assume 5 different scenarios of premium acquisition, ranging from 50% to 75%. This scenario will change the purchase price of the target company, and it also affects the stock consideration under the uses of cash.
Through the previous models and analysis, we can know that in this M&A case study, the pro forma statements reveal that due to the synergies achieved, the total revenue is projected to grow significantly over the next few years. Additionally, the synergies are expected to have a positive impact on the overall profitability by reducing expenses in categories such as cost of goods sold, marketing, advertising and promotion, and general and administrative costs. But also, there are some risks that need to be awared. The first one is financial risk. The presence of errors in the pro forma model's forecast could indicate insignificant financial risks or uncertainties post-acquisition. And the second one is cost considerations. Significant restructuring charges, debt replacement needs, and other closing costs could make the acquisition financially less attractive than anticipated. The last one is potential overestimation of benefits. If synergies or cost savings are overestimated, the actual benefits of the acquisition might not justify the initial costs and risks involved.
While this acquisition presents significant opportunities, it also comes with challenges that require proactive management. Allow me to address these risks in 4 key categories. First one is financial risks. Overestimating synergies is a critical concern. If projected revenue growth or cost savings fail to materialize, the acquisition's financial value may fall short of expectations. Additionally, integration costs, including restructuring expenses, could strain our resources. Any errors in financial forecasting may lead to discrepancies between anticipated and actual outcomes, putting pressures on our plans. Second is operational risks. On the operational side, integration challenges loom large. The consolidation of operations, technologies, and teams from both companies may face delays or inefficiencies. Moreover, cultural differences between the two organizations could cause conflicts or lower employee morale. Any service disruptions during the integration phase could harm customer satisfaction and damage our reputation. Third one is liquidity and funding risks. Internal funding, increased debt to finance the acquisition could affect our liquidity and financial stability. Issuing new shares as part of payment might dilute existing shareholder value, leading to dissatisfaction among investors. The last one is market and competitive risks. In terms of market risks, we may encounter customer attrition. Docker-sized clients might view this acquisition with skepticism, leading to dissatisfaction or disengagement. Market perception is another factor to consider. Negative stakeholder reactions may impact our stock's price and brand reputation. Additionally, competitors may exploit this integration period to gain market share. To conclude, this acquisition holds significant promise, but also requires a disciplined approach to risk management. Thank you for your attention.